When we talk about artificial intelligence, the conversation usually revolves around generative art, coding assistance, or the fear a software program might take your job. But as these digital tools evolve, they are creating a much more physical problem, one that directly threatens your personal finances. For the past couple of years, the biggest story in the economy has been inflation. After a long period of rising costs, price hikes had finally started to cool down. The Federal Reserve has been working to bring the economy back to a stable 2% inflation baseline. Now, however, economists are pointing to a new headwind. They warn that the explosive rollout of AI could be the catalyst for the next major wave of inflation. To protect your own wallet, you have to look past the software and see how lines of computer code trigger real-world economic consequences. It is easy to think of AI as weightless information floating in the cloud. In reality, processing that data requires a massive, heavily industrialized physical footprint. By 2026, major tech companies are pouring hundreds of billions of dollars into massive facilities filled with specialized servers. Building these centers requires extreme volumes of advanced computer chips, creating fierce corporate competition for a limited global supply. Once those chips are installed, they need staggering amounts of electrical power to run the complex calculations required by language models. Because all that computing generates intense heat, these facilities also demand expensive industrial cooling systems just to keep the hardware from melting down. This diagram illustrates the result. As tech companies buy up fixed supplies of copper, water, electricity, and processors, the baseline price of technology infrastructure and power drives upward for everyone. The digital AI revolution is physically constrained by finite resources. Right now, tech giants are outbidding the rest of the economy to get them. This shift affects more than just Silicon Valley. Think about a standard business, a logistics company, like a hospital or a local bank. They all rely on basic cloud servers and electricity to operate. As tech giants squeeze the global supply of computing and power, those basic operating costs for normal businesses begin to surge. When overhead spikes, leadership faces a choice. They can absorb those financial losses and hurt their own profitability, or they can pass the burden downward. To survive in a competitive market, the majority of companies choose the latter. They adjust the prices on their own goods and services to cover the difference. Eventually, that ripple reaches the end of the line. Standard services and everyday goods become more expensive for the average citizen. A massive corporate investment in an AI data center halfway across the country can quietly push up the final total on your grocery receipt. Which brings us back to the Federal Reserve. Their mandate is to manage the economy so that inflation stays around that 2% mark. But the scale of AI infrastructure spending is creating a persistent layer of inflation across the entire supply chain, making that 2% target difficult to reach. This causal loop diagram shows the Fed's primary weapon for suppressing that inflation. They have to elevate interest rates to cool down spending. When inflation pressures stay strong, that interest rate metric remains locked in a high, restrictive position. Economists call this scenario higher for longer. As long as AI continues to drive core inflation, borrowing money will remain structurally expensive for years. For the average person, this translates directly into financial pain. It means mortgage payments are kept high, pricing prospective buyers out of the housing market. It means financing a vehicle with an auto loan takes a bigger bite out of your paycheck. Credit card balances compound faster, and small business loans become riskier to take on. The rapid expansion of AI is now colliding with the limits of the physical economy, forcing a choice between the speed of technological growth and the stability of the consumer's wallet.